What if I told you that some of the wealthiest investors actually get excited during a bear market? Sounds crazy, right? But it's true. We're diving into the secrets that the rich use to turn market downturns into massive opportunities. Stick around, because by the end of this video, you'll be armed with the strategies you need to invest like the pros, even when the market is tumbling. Ever wondered what a bear market truly is? When the stock market plunges by 20% or more, we enter the territory of the bear market. In 2022, this became reality for U.S. stock markets as the S&P 500 dropped over 20% from December 2021 to June 2022. Canada's market, by contrast, saw a milder downturn, typically called a correction. Although the term's origins are shrouded in mystery, in financial jargon, bears symbolize pessimism, while bulls signify optimism. Bear markets emerge when significant shifts in market conditions trigger a decline in corporate profits or cause valuation multiples ratios like stock price to earnings or book value to shrink. These changes can stem from a variety of sources. Soaring inflation and interest rates, think 2022. Bursting asset bubbles, remember the housing crash of 2008, or the dot-com bust of 2000 to 2001, or events that shake investor confidence like the COVID-19 lockdowns in 2020. Often, bear markets are harbingers or companions of economic recessions. In a bear market, the influx of capital into stocks slows to a crawl while outflows surge. Many investors, gripped by fear, sell off their stocks, frequently at a loss. So, where does all that cash flow? It often lands in bank accounts or is funneled into lower-risk assets such as government bonds. As stock prices plummet, vast amounts of market capitalization evaporate. Bear markets, on average, last 389 days from peak to trough. Since World War II, the U.S. has experienced 13 of them. For many, the 2008 to 2009 crash is etched in memory. This particularly brutal bear market stretched 517 days, starting from its peak in October 2007 and bottoming out in March 2009. Savvy investors know that bear markets can be rife with opportunities. The key lies in staying calm, recognizing the patterns, and making strategic moves when others are driven by fear. How to trade in a bear market. Navigating the choppy waters of a bear market can be daunting, even for the sharpest investors. The market's highs and lows are notoriously unpredictable, and those who attempt to time their trades often find themselves selling at the worst possible moments and missing out on subsequent surges. However, investors with a long-term perspective can transform these turbulent times into golden opportunities for building future wealth. Here's how. Number 1. Controlling emotions. You've carefully chosen solid companies with robust business strategies, yet the market takes a sudden downturn. This is where emotional mastery comes into play. Instead of succumbing to panic and selling at a loss, consider the approach of seasoned investors. Rich investors understand that market fluctuations often amplify emotions more than they reflect true value. They recognize that quality investments, backed by sound fundamentals, have the resilience to weather storms and rebound over time. By keeping emotions in check and avoiding knee-jerk reactions, you not only protect your investments, but also position yourself to benefit from eventual market recoveries. Think of it as a test of patience and strategic foresight. While others may be gripped by fear, those who stay composed and focused on the long-term prospects of their investments stand to reap the rewards of their disciplined approach. Number 2. Seeking calmness. While it may seem unconventional, navigating the choppy waters of a bear market can be a gateway to substantial gains over time. The key lies in maintaining focus amidst the clamor. Continue your steadfast journey by consistently adding to your savings, realigning your investments annually, and harnessing the power of compound interest through dividends. Remember, patience is not just a virtue, but a potent strategy. History reveals that enduring market downturns often precede robust recoveries that outpace inflation, rewarding steadfast investors with impressive returns. Number 3. Consider diversifying your holdings. In times of market downturns like bear markets, the value of most investments tends to slide. However, not all assets decrease in value equally. This is where diversification becomes your secret weapon. Imagine your investment portfolio as a sturdy ship navigating stormy seas. By spreading your investments across different types of assets like stocks, bonds, real estate, and commodities, you're not only safeguarding against sudden drops in any one sector, but also balancing out the overall risk. While some sectors may be taking a hit, others could be holding steady or even thriving. By smartly diversifying across various industries and geographic regions, you're positioning yourself to potentially cushion the impact of a downturn. Instead of putting all your eggs in one basket, consider spreading them across multiple baskets. This way, you're not only protecting your investments, but also setting yourself up for opportunities that arise amidst market turbulence. Number 4. Consider a defensive play. In tumultuous times like a bear market, strategic investors often turn to defensive stocks. These are the stalwarts of stability amidst market chaos. How do you spot them? Look for stocks with a history of steady price movements compared to others in their industry or the broader market. Such companies typically boast substantial market capitalization, consistent profitability, generous dividends, manageable debt levels, and strong competitive advantages known as moats. These protective moats can include being in heavily regulated sectors like telecommunications, utilities, banking, energy, or railroad infrastructure. These stalwart companies often reside in sectors where demand remains robust regardless of economic conditions. Think consumer staples and residential rentals. Number 5. Dollar cost averaging. Gone are the days of sporadic savings deposits. Instead of scrambling to stash cash sporadically like during those hectic RRSP seasons in February, why not take a page from the playbook of financial wizards? Automate your savings with regular monthly or bi-weekly contributions. Not only does this practice ensure you prioritize yourself financially, but it also positions you to capitalize on the unpredictable rhythms of the market. By consistently investing a fixed dollar amount each month, you inherently buy more units of an investment when prices are low and fewer when prices are high. It's like clockwork, effortlessly seizing opportunities to buy low, a cornerstone of prosperous investing. Number 6. Tax loss harvesting. When navigating the stormy seas of a bear market, savvy investors turn setbacks into strategic advantages. Enter tax loss harvesting. This tactic is your secret weapon for making the most out of non-registered accounts that get taxed. Here's how it works. When stocks or funds in your portfolio plummet, you sell them at a capital loss, the gap between your purchase price and the lower sale price. You can use it to offset other income, potentially reducing your tax bill for the current year or even future years. Often, these aren't investments you were banking on to recover soon anyway. Instead, they're the dead weight you've been meaning to cut loose. This way, you're not only cleaning up your portfolio, but also setting yourself up for financial gains down the line. Number 7. Keep an eye out for signs of a recovery. While pinpointing the market's exact low or high is impossible, you can still get a feel for when a turnaround might be on the horizon. For instance, if periods of job losses start giving way to months of job gains, it might hint at an economic rebound. Likewise, a shift towards normal inflation rates around 2% to 3% annually could signal a return to a stable economic environment. These indicators might prompt you to make strategic moves, alleviating some of your investment worries. A bear market can actually be a prime time to deploy your capital. Imagine some stocks from last year are now significantly cheaper, presenting a golden opportunity for savvy investors. It might take a year or even several for these investments to regain their previous value. But if this matches your long-term goals, it's a chance worth considering. The key is to focus on wealth building over the long haul. And a bear market can be just the opportunity you need to set the stage for future success. Thanks for watching. If you found these insights valuable and want more tips on mastering the market, don't forget to hit that like button and subscribe to our channel. Tap the notification bell so you never miss an update.